Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to Geoff Gannon. Jeff, how are we doing?
It's going very well, Andrew. How's it going with you?
It's going just peachy, Jeff.
Okay.
Just peachy. We hope it's going just peachy for everybody else as well. If this is the first time you are tuning in, make sure you hit that subscribe button, both on podcast and the YouTube side of things. Check out my Twitter at Focus Compound and go to focuscompound.com to get access to writeups that Jeff writes up for Focus Compounding. So in today's podcast, what we're doing once a week, more of a free form, talk a little bit more about what's going on, stuff we're seeing, as well as answering questions from listeners. So to be able to do that, you could either DM them to me at Focus Compound on Twitter, or you can email them to me, Andrew at focusedcompounding.com. So what's going on right now in the market? I think I really want to title this, it's probably bad SEO, but like, what the hell is going on? There's a lot of weird stuff going on right now. With Viacom last week being down like 30% in a day. We don't need to name names, but Viacom has been on a tear.
Right.
The past, since really 2021. I asked somebody. Somebody just put an envelope under our door. I asked somebody, I'm like, what's going on in Viacom lately? Because if you looked at the chart, It was just straight up.
Yeah.
And he was a shareholder. I think he was like, I literally have no idea. But then Friday, Viacom, as well as a few other Discovery Inc., I think, and also some Chinese internet companies were down massively. And it sounds like there's a huge margin call going on in the market right now.
Okay.
By a $10 billion family office that use swaps, use a few different things, and it's rumored.
Net, it's got to be a lot more.
They're talking 50 to 60 billion.
Yeah, 10 billion. Yeah.
And I went on a little bit of a rant about this in the car on the way here. We were talking about it. And first of all, I said, if you have a $10 billion net worth and you're just running the gun like that much, I mean, I use different words, but I'll just say you're kind of a jerk. I mean, it's just like, what was your lifestyle going to change if you have $10 billion or you have $100 billion? Absolutely not. So, I mean, just like crazy. So, I mean, I hate seeing everything that's going on, but it's just insane. And now there's banks coming out, Credit Suisse.
Investment banks,
saying that they may have exposure to this that could materially affect the earnings of the companies coming up. There's a lot of banks warning of significant losses as they try to unwind this position that they have with a family office. And again, we're bringing it back to leverage. And we talked a little bit about this with the Occam's Razor podcast.
Okay.
How sometimes when there's different booms and manias going on in the market, people look at Buffett and Munger and say, oh, they're just the old guys sitting there. What do they know? They're not new. They're not still learning. They're not in their prime. And a lot of the advice they give is timeless. Munger says 3 things could kill you in life: drugs, alcohol, leverage.
Right.
And to stay away from it. And again, all we're trying to do here, we talked about in the last podcast, is over a bunch of different outcomes. You want to skew your odds to being on the favorable side of things. So it's staying away from things that may work once, may work twice, may work 5 times. But the 6th, 7th, or 8th time that it doesn't work, you blow up in a very big way. So there's this total speculation because we don't know yet, but it sounds like the notional exposure. I mean, some people would even say 80 billion. And you saw a massive margin call of banks, trying to bring in that capital, and it was punishing a lot of different stocks. And you've been hearing, there's been a lot more people talking about this with like ETFs, like super high growth ETFs. You don't need to name names, but anyone that listening probably knows who we're talking about, how eventually it could cause an issue for them, illiquidity, and it could, blow up a few different companies, which could present interesting opportunity. So it's like a Viacom, for example, being down 30% in one day.
Oh, you mean because you have to unwind?
Yes.
Yeah.
Correct.
Okay.
Forced liquidation.
Yeah.
So I don't know. I mean, do you have any thoughts on everything that's going on in the market right now?
Well, yeah, this is interesting because it's similar to some other ones. Some of the stocks specifically, I don't know all of them, but Viacom and Discovery were interesting because they reminded me of the things like GameStop and AMC and all that, where they were actually interesting value investments not that long ago, and then they started going crazy and attracting a lot of attention and all of that. No, but I did know that crazy stuff was happening when the price of those particular stocks, because I looked at those. I mean, I do know Viacom and Discovery pretty well.
That's it.
Yep.
That's probably smart opinion. No, it's just the whole thing of leverage, right? We don't use leverage. You don't use leverage. Now you've done certain things with leverage before, right? Like if you ever did a short or something along those lines.
Well, if you're short, then you have using leverage. But I mean, we are talking about a couple % of a portfolio when you're doing that versus many times the size of the business.
Why do people do that?
I don't know the details of this one. I mean, why you do it with something like long-term capital management or those sorts of things is that you have to take advantage of a very small spread that is very certain. And so then you have to use a large amount of leverage. I mean, you can see that with banks, right? So what the net interest margin of a bank might be 3% or something. Mm-hmm. So without using, even if you had no expenses, no non-interest expenses running the bank, well, to get a decent return, you have to use about 4 times leverage just to do that. And then you have other expenses and things. You need more leverage than that. So that would be why you do it. It also, in a sense, is why the spread can be that small.
Sure.
I mean, so the spreads have to be very wide on things if no one can use leverage. I mean, you could imagine making markets, things like that. If no one's leveraged who's dealing in a stock, then the bid-ask spreads can be very wide. If you intend to make tons of money, on a ton of different, on a lot of transactions at a very low amount, a very low spread, then you're using a lot of leverage, which you intend to use for a short period of time. And the issue with a lot of stuff for the financial system for leverage things is that it tends to be that stability creates instability. So if the perception of the world and everything is that things are unstable, if people are unwilling to lend and all that, then people don't engage in behavior that's destabilizing, basically, because it doesn't get financed. But if you do have a lot of stability, then you're given a lot longer leash to do things that might create instability eventually. So ironically, if you keep rates at the same levels all the time, if stock prices tend to be at the same level or rising without a lot of down declines or whatever asset you're dealing in, if people are kind of willing to finance things, if you have a really good credit rating, I mean, GE and AIG and stuff could never get in as much trouble if they didn't have such a good rating in the first place. Then you can do a lot of things that end up being destabilizing, right?
Mm-hmm. I'm just curious, how do you stay away? How do you have a successful career where it's like you don't end up in the newspaper with one of these stories?
Well, you could just not use leverage at all. I mean, you can get plenty good returns in stocks by not using leverage.
Do you think it should be regulated more?
I don't know, because I'm not sure how much danger this poses to the system.
It's just so it's like Credit Suisse came out and said, oh, it may have some effect. There's a couple other banks too. And I was like, wow, this is totally reminding me of when I'm reading in these books, like 2008, they're like, oh, right, we could have some effect. And it's like, then they just throw the freaking kitchen sink at it.
Yeah. I mean, maybe you could regulate the banks and their behavior towards it, but it's a lot of...
Who's at fault? The prime banker that allowed them this type of leverage? Or,
I mean, are they at fault for doing this?
Yeah. Or prime broker.
Yeah. I don't know. I mean, yes. I mean, you're talking about running money for other people and losing a lot of it by having a lot of leverage. That's a pretty big problem. But yeah, are the banks also responsible? Yes. We're not going to get into all of this situation, but there's stuff here that probably should have made you not take certain risks. I mean, I don't know if you remember, but Charlie Munger's mentioned before about Solomon and them getting involved in a couple different deals. Mm-hmm. And what was known about some of the people and the deals they did, and they still wanted to do them. If it's enough money, this wasn't. There's some things in the background here that would have already raised flags. So.
Oh yeah, the $44 million insider trading.
There's just stuff in the background that would have.
Got it.
Yeah.
Somebody asked, I'm considering going activist and was wondering why you and Geoff have chosen not to. Does it make sense for you guys to run a public company? From my perspective, it gives you one more way of increasing returns by buying back when shares are cheap and issuing when expensive. For instance, the net asset value, the NAV, could be 100 and the stock trades at 80, so you could buy your already cheap portfolio at a significant discount to its market value. So any thoughts on that?
Yeah, that's true. It gives you more options that way. Absolutely. Yeah.
Yeah. If you read a lot of activist situations, I feel like it always looks a lot more like a slam dunk from the outside. And then you get on the inside and it's very, from what I've spoken to people about, it's much tougher. It usually always ends up being much tougher than they thought it would be, which is like business in general.
Yeah.
But very tough.
We deal in smaller stocks. My biggest concern with when people take over smaller stocks and do proxy fights and all of that is that they tend to remove the actual operating managers involved in it. If it was a situation where there was a change in the board or something, without a change in who the general manager was, who the people running plants were, and things like that, then I wouldn't have the same concerns. But that tends to be what it is. I think people underestimate the operational difficulties of a business that way. But I don't have anything against activism. Yeah. And we sometimes own meaningful amounts of stock in companies, and, I mean, I do, I guess, have some stuff against activism in the sense of buying a fairly small stake, making a very public announcement, not ever being in a position in which you could change things at the company and stuff like that. I think we would tend to be fairly not public versus the amount of influence we could have on a company versus the opposite way. I don't like the buying a couple % of a company and making a big announcement kind of thing when someone else owns 10 times more than you do. And so there's not much you can change,
Mm-hmm.
That creates a fervor around the stock, gets attention to the stock and stuff, but that's not quite activism. I don't know how this is the right word for it, but it's not really activism in the sense that you're ever going to want a proxy fight or something.
It's like they're just looking for the pop.
Yeah, it's
get
sort
a
of like
bunch
doing
of
a presentation
attention,
on
other
the
people
stock is getting
come.
attention for
Yeah.
it. Yeah, I don't like that as much. But activism that changes things at the company, I don't have a problem with that.
So it's really getting back to, again, like, buying the business as opposed to making a trade.
Yeah, and the other thing is, other things equal, we prefer to buy into a situation where we like management, like what they're doing. It's really hard to change that in a way that would be as beneficial. So it is true you can do some things to like buy into a situation that's really cheap. You don't like management. You could do some stuff to kind of mitigate that a little bit, but you're probably still not going to end up in a situation where you really love what you're going to get. It's much easier to find a management that you like and's already in place than to somehow find them and put them in there.
It's better be a team player.
Yeah. But of course, sometimes you end up in activism over time, and that's very reasonable. That wasn't your intent going into it, but things happen and whatever. So that's always the case if you own a meaningful amount of stock, that things could happen. Sure.
If you want to read a pretty cool story on an activist getting involved with a company, read Railroader about Hunter Harrison and when Pershing was getting involved with Canadian Pacific and what that process was like, and the proxy fight and fighting with the board and screaming and all that sort of fun stuff. It was a great book.
Yeah,
they went into it.
I once wrote a letter to a board. I did do it one time.
No, you've written
two.
Yeah, you've written another one other than that one that you're talking about.
I don't think officially I have.
We have.
But yeah, no, I mean, as an individual investor, I one time wrote a letter to a board. But
did they respond?
That was a very specific, issue with a buyout offer or something. So it was very not operational. I don't think I really want to get involved in things changing how a company operates and stuff like that. But if you mean like saying a company shouldn't take this buyout offer, or here's things to consider about a different way of structuring the deal or whatever. That's different. I would definitely consider that if it's purely a matter of some capital allocation things, or especially a thing about a buyout and how it should be structured and things like that. Yeah.
Somebody asked, can you guys discuss if you subtract out the stock-based compensation cash flow line item when calculating free cash flow? If not, why not?
No, I don't take it out. I estimate how much the dilution is going to be over time, and then I use that as a drag on my total return. So this is confusing to people, but so if I say that something's trading at like 12 times free cash flow or something, it's really not, because it has stock compensation. How I really figure it out is I always calculate how much of a return I think I'm going to get in a stock over time, and I subtract out how much I think that dilution will be. So there are companies where I think dilution will be like 2% a year, and that's a permanent drag on my returns. So over 15 years or something, that's equivalent to a very big difference in free cash flow. But I do the estimate based on my expectations for long-term dilution, and not what it is in any one year. I think that the stock compensation in 1 year is not very good measure of what it'll be over time, because they're so different how different companies do it. So I pay more attention to like whether a company would, because some companies will reprice options, issue a lot more to people and stuff in a downturn for them, things like that. So you could see where they do a lot of diluting. I use much longer term things. Yeah.
It's like the opposite of if you're doing like adding like the dividend yield to your return.
It's a negative
doing
dividend
the opposite
yield.
of it.
Absolutely. Yep.
Here's something that we talk about a lot. How do you think about allocating time to getting familiar with great companies that are obviously overvalued?
Yeah.
He says, I'm wondering if you're spending time to prepare for market corrections / crashes, like in March of 2020, when great companies can be bought at bargains. So and you've talked about this too, right? How it's challenging sometimes when you are reading an annual report or a 10K and you know 100% you're not going to buy it today,
right,
or soon.
Mm-hmm.
It's hard to do.
Yeah.
Your brain has a finite amount of, horsepower.
Yeah.
And how you allocate your time, this idea of focus, is so crucial to being successful, especially in investing. One man, investment team.
Yeah.
And being independent like that.
Yeah, I think it's probably a good use of time, probably, if you can't come up with a lot of other things. It's a good use of time even then, if you have enough of it. Now, some people talking to us aren't going to be reading a lot of 10Ks, but if you are, having half your time spent on things that are too expensive, but you might be interested in the business a lot, is fine. That's not a problem. There is one danger, though, that I've noticed with people, which is if you spend a lot of time thinking about that business that you can't have now because it's too expensive, sometimes it does create a sense of like scarcity and stuff when it does come down in price, so that you may be overly aggressive buying it and not revisiting what's going on with it and all of that, because you're like, this is my big chance to finally buy this company that I know. So I have seen that happen with people, actually, that I've followed this company forever and now it dropped a lot and now I'm going to buy. That has happened. So I would be a little cautious about that.
Somebody was asking about Fairfax Financial.
Yeah, I don't have strong opinions about Fairfax Financial.
Yeah, he said it being the cheapest it has been in decades. Why do you both feel it's not getting much love?
It's a good question. I don't know the answer to it. I haven't read an annual report of it recently, so I would have to check that. I think Berkshire is fairly cheap compared to what it's been before, and actually there are a few other insurance companies that are fairly cheap. Fairfax is also somewhat value investing in terms of its approach to portfolio stuff, especially kind of, I guess you could say, deeper value and stuff than Berkshire, and Fairfax is more of a straight up insurer. Yeah.
Let's see. We get asked this a lot.
Okay.
Again, maybe it's part of the times we're living in. If I could find it, I just scrolled past it. You and Geoff talk about intrinsic value before and talked a bit about companies that grow a lot. it would be interesting with an episode to hear about high growth companies, those that technically deserve an infinite EV to free cash flow, and how you would sift through that. I would say it's hard to come by. Infinite is a pretty big word.
Yeah, well, I mean, they could lack free cash flow now and be worth more in the future. I think we had a write-up on our website at one time of Box, which is the kind of thing that if it eventually grew fast enough and developed into a more profitable business along the lines of the economics, what it seemed the economics might be of the business, then it could be worth a lot despite the lack of profits at the moment. I think, let's see, there's certain other companies like that have fairly high retention rates and theoretically would have nearly pure profit. I mean, it would have to be something with a very high gross margin, but of course it can even appear that the gross margin isn't that high in the very early years for a truly like new technology type thing, but usually you would need very high gross margins. When I complain that some company is overpriced, you'll notice that usually it's not a company with a very high gross margin. Sometimes it is. But to be extraordinarily clearly overpriced, you probably need to be priced pretty high versus gross profits, which is a number I would use, price to gross profits. And then your gross margin has to be reasonably low. So that is why I complain about something like Tesla. It's not an industry that has high gross margins. The company doesn't have high gross margins. So even though the price to sales might seem like something that's paid normally for super high growth stocks, it can be a little more extreme. A good example of something I would avoid valuing that way would be like Chewy, right? So Chewy is a very fast growing company, has a lot of potential to grow really fast in the future, but you have to understand that it's priced at an extremely high level versus the level of gross profits in the industry because pet food has very low gross margins, which is very different from like a software company. So I would value like a software company or something like that a lot higher than I would a car company or a dog food company. Yeah.
Yeah. Elon Musk, his new title is Techno King of Tesla.
Yes. Yeah.
Were you surprised to hear that they bought a bunch of Bitcoin?
Not really.
Yeah.
No. I don't know. Not exactly. They do some stuff to get some publicity.
Mm-hmm.
I don't know. I think he understands how to attract
Work
attention.
the system.
Yeah. I don't know that was a huge amount, right? Versus how much their market cap is and stuff.
Yeah, it was like $1 billion.
Yeah.
And their market cap's whatever it is, hundreds of billions.
Yeah. A lot of companies do things where they say they're now accepting Bitcoin or something and get some press from it. It's interesting why they do it, but I think that there's an awareness of the news that they get from it, and that's a big part of it, I would say. I don't think it will make or break them if they happen to lose $1 billion or something from a transaction on that.
So talk to everybody. What's been going on with Geoff Gannon? What's new? What are some any interesting companies you've come across recently that you're either going to write up or that you think is worthy to talk about?
No.
People are very interested in the process towards things. Anything new that you've implemented or that you think has worked for you and may work for others?
I would say no to that. No, I haven't had a lot of new things that I found recently. I did mention that a stock we get asked about all the time that I did not write up, Cambria Automobiles.
Yeah, that was an interesting story.
Yeah, there was management buyout offer for that. Yeah.
Yeah, what are your thoughts on that? Should Virtu go and make a big acquisition?
Well, but how would you? Because management wants to buy it out, and management owns 40% plus. It's the all of the top management people involved in it. So it's a fairly low valuation on a price to tangible book. It's high, but they do luxury cars, super luxury type things. So it's fairly low on like an EV to EBITDA. I don't know. Depending on last year's EBITDA, it might not look that bad.
It's a shocker,
but it might be 4 or 5 times peak EBITDA. It'll be a low number. number. So to take a company private at that price is pretty. It's a pretty low price, right? But it's a management buyout, so you might not get better than that. And it tends to be the case in the UK that you don't do as well as in the US because of the way that their system works. This kicks in some stuff with the takeover code and stuff like that. So when they try to make a buyout, it then brings in certain rules about who can do what over a period of time. However, it is interesting that they wanted to buy the whole company at the price that they did so quickly after, the pandemic. It would be fairly easy for them to do it, I think, because they own about 40% of the company, which means you only need the other 60%. And given the price to EBITDA I just mentioned, you could probably borrow it from somewhere. So you basically can do it without putting in equity. I mean, you already own 40% of the company, but taking out the other 60%. So
I saw some shareholders were revolting on message boards.
Yeah, well,
just acknowledging it. And it's true.
I mentioned that I made a lot of money in a deal like that. Management made a buyout offer. I thought the buyout offer was too low. Bought as much stock as I could. Eventually, they offered more. But that was in the U.S., not the U.K.
Yeah, I guess you don't start high as the highest you could possibly go when you're gonna want to buy out a company, like a management buyout.
I guess, yeah. And like I said, and there are rules in the UK. If they continue to go forward with it, there's a date that they would have to decide if they want to continue to go forward with it or not. Once they do, they're bound by certain things. It's a whole different dance than in the US.
Did it shock you that Hunter Douglas did a very similar situation?
It didn't shock me, yeah.
I mean, whenever you've talked about the company, kind of a take under was kind of a risk that we always talk about.
That possibility, yeah. So Hunter Douglas, the family in the last decade or so had about a decade, last decade or so of its life, maybe a little bit more than that as a public company, had bought back from the point of about 50% to like almost 90% or something of the company, and then took it private. And, they had it in a jurisdiction where that was likely to work out better. Not that you couldn't do it in the U.S., but it would be harder. I mean, I think you get a higher price in the U.S., but that's more because of the way the board works and stuff, I'd say.
So we talked a little bit about Progressive on a different podcast, but somebody said that I like the company very much. They have an excellent management, but I always find it hard to forecast earnings in insurance companies.
Right.
So he was wondering if we could help him get a better idea of how to actually value insurance companies and what are the key metrics to include when calculating intrinsic value.
So with Progressive, the way I broke it down is long-term average. What do I think their underwriting margin will be? Applying that and then putting a valuation on that and then putting a value on the investment portfolio completely separately. So in other words, you do a calculation like you say, let's say premiums are, whatever number they are. And you say, okay, let's take, you want to look at PGR right now so we can see the premiums? Okay, so this will be earned premiums, I think. So what were they last year?
Earned premiums, $39 billion.
Okay, so let's say earned premiums are $40 billion, right? And you say, okay, they have this target to hit a 96 combined ratio. Do I believe that? Well, you can look at decades of past results to see if you do believe that. And if you say, okay, I think they'll make 5%, so that would be a 95 combined ratio, then 5%, then they're going to make, $500 million for every $10 billion that they write. They're writing $40 billion, so they're going to make $2 billion in underwriting profit or something is what you think they're at now as their normalized level. So let's say you took that number. Then you put a multiple on that. Like you say, okay, so is that worth 10 times pre-tax income? Does the average company or is a company of this quality or average company, whatever you want to say, deserve to trade at like 10 times pre-tax? Maybe it does. So then you put 20 billion there, and then you do the same thing from the investment side of it, right? And you add them together because both sides matter. That's the thing. You get both pieces of it. Now you can add the investment side by taking the entire portfolio and just valuing at what it's worth. However, you should be warned that because of the way a lot of insurance companies work, and certainly Progressive, they're going to get lower returns on average on that portfolio than you would like. So your stock portfolio is going to outperform their investment portfolio because they keep a lot in shorter term cash type investments. So then you add those two parts together, and then in the case of Progressive, you might have debt that you have to take out, but that's how you do it. I would say those are the two parts that you break down. And you look at the very long-term past, what their underwriting has been, what their combined ratio has been, and compare that. So when I say combined ratio, I want you to look at their expense ratio and their loss ratio as two separate things, and the combined ratio together. But also then you compare them to other companies in the industry, and they have that data. At least versus the industry, it's very easy to find. And even in the case of Progressive, you can find it for specific competitors like Geico and USA probably. But you certainly can always find it for the industry, like comparing them. So are they always a little bit better than the industry? Things like that. If the industry is writing at 100 on average for 30 years, are they a few points below that? However, if you're asking, can you predict the next few years? No. I mean, it's cyclical.
Mm-hmm.
So it really depends. Trying to predict something like that is like trying to predict the stock market or something. There are things happening that can build momentum for a little while, but people will realize that what they're doing doesn't make as much sense, and they'll pull back from it eventually. And then when things get really cheap, then they'll push into it a lot. So it is like a stock market that way. It has that kind of cyclicality because profits will attract more competition, basically, but eventually you'll see prices reverse on anything that good times or bad times will not last for too long in the insurance business. So you do need to look at the very long term and come up with a cyclically adjusted number. You really don't want to use the last few years of earnings or something. If you hear us say like the PE of this stock or whatever, if we say of some brand business, right? So if you said Hershey or something, it doesn't really matter. I mean, maybe it matters in a COVID year, but it doesn't matter in any other year. But for an insurance company, don't just use the last year's PE, because there'll be some years where the combined ratio is really good and some years where it's really bad, and it's purely cyclical. You want the long-term average.
Got it. Speaking of Hershey, I came across this 2 weeks ago.
Okay.
It always shocked me that Buffett didn't purchase this company.
Because he's talked about it.
Uh-huh.
Yeah.
That ever shock you? Seems like it would be right in his wheelhouse.
Well, it hasn't really been available for sale.
Yeah.
The entire company because of the trust.
Yeah.
And then the price isn't necessarily all that low. A bunch of candy companies, the price isn't all that low. He invested in a way through Mars Wrigley, that one deal that he was able to do that way, but he's always liked Wrigley and Mars. So it's an area he's wanted to invest in, but you notice he doesn't. There's lots of companies he talks about and doesn't buy into. He would use the Wall Street Journal as an example of a great business many times, but didn't own the stock itself, which is interesting. So it really depends on the price, and maybe he never got the price that he liked.
Just admiring from afar. Yeah,
I can't think of a time when Hershey's stock was really cheap. I could be forgetting a time in the recent past. I'm always amazed at how expensive Tootsie Roll was.
That's another one.
Yeah. Now, I think that may be also that people always thought, well, it's a possible takeover candidate, which is true, given its size and everything. But it always traded at a very high sort of multiple, very blue chip kind of multiple. Yeah, which isn't necessarily wrong. I mean, it's very safe stock.
Revenue's gone nowhere over the past 10 years.
Yeah.
10-year CAGR on revenue, negative 1%.
Yeah. Yeah. And, they're businesses in which you have almost no growth, so it's hard to pay a really high price. Sure. Now, there's a lot of safety, but
35 times free cash flow. Yeah,
it can be hard that way. So I've always avoided ones like that. We've talked about food companies and why I don't like them as much as just the price. I mean, it's okay to pay that high price if you have really good returns on equity and fast and some real growth. But if you have basically no growth, I don't think you ever want to pay a high multiple for something, because you can't. I mean, maybe if you had amazing capital allocation by someone like a Buffett or something, but absent that, you're not going to be able to reallocate capital at better than average returns. So why would you want to pay a high multiple versus the earnings you're getting? So like if you need a 10% return in a stock and you're paying more than 10 times free cash flow, because you're saying, well, Hershey's or Tootsie Roll or something is a great business. That's true if that business grows like at all. Mm-hmm. But if it doesn't grow at all, then you're not really reinvesting that cash flow back in the business. It's just cash. So what does it matter what company it's coming from? Now you could say, well, it's the safety of it. And I agree with that. The risk is very low. But how big is the safety difference in a government bond versus a junk bond? You can measure that. It's not a huge percentage difference, right? So you don't really want to pay, I think, 3 or 4 times more for a business. I mean, in terms of the yield difference, that's huge. We're talking about you're getting a yield of 3% free cash flow yield or something instead of 10% in some other stock that you could find that's riskier. It's a very big spread,
Yeah. Interesting. Cool. Well, I want to thank everybody so much for tuning in with both of us. If you want to email me your questions or DM me your questions, and we will talk about them throughout the show, just like we did here today. It could be basically about anything, whether it's from, just the process or individual accounting questions or just questions about business in general. We want to talk about what's on everybody's mind. So DM them to me, or you can email me, andrew@focusedcompounding.com. I want to thank everybody so much for tuning in with both of us. Leave us a 5-star rating. That goes a very long way. That puts a smile on my face. We appreciate all the support, and we will see you in the next podcast.